go to our featured guest of the morning. He's John O'Connell, CEO of Davis Rea. Thanks, first of all, for coming in. It's good to see you again.
Thanks for having me on.
Okay, I know you know these stocks very well. You're a big believer in some of the names that make up the Nasdaq 100. The Nasdaq 100 is different than the Nasdaq Composite in that it includes the 100 largest non-financial stocks that trade on the Nasdaq exchange. So it is not the same as the Nasdaq 100. There's significant overlap because these, I think, are the 100 of the most influential companies in the Nasdaq Composite. But it's a different exchange. And unlike the Nasdaq Composite, it has now hit a record high. What's your take, John?
Well, it was sort of inevitable, I think. People are always trying to talk about growth versus value and buy small caps versus large caps. And I think, if you look at the composition of this index, it composes some of the most valuable companies because they provide some of the most valuable products and services in the world. And we're going through a major change in our global economy. Technology has always played an important part. In the old days, it was General Motors and Ford.
Right.
Today, it's technology and software. Software is eating the world, so to speak. So, people are constantly trying to get you to buy and sell different things. My sense is you just should own great companies. So, you were talking about Ford this morning and the E150. Why wouldn't you just buy some of the important components of that car and not be involved in the heavy capital intensity of manufacturing a car and competing against other car manufacturers, where really the outcome of the sale is personal preference and taste in terms of the style of car you want. So I don't think it's surprising, and people scream up and down that these companies are expensive and that kind of thing, and some of them may be more expensive than others. But the bottom line is, it depends what your time frame is.
Yeah.
And they are the most valuable companies because they're the most profitable companies too.
Here are some of the companies that make up the top 5 or 6 names. They're all very, very familiar names. Microsoft, which is now the most valuable company in the world, is a member of the Nasdaq 100. Apple, as you can imagine, there's Microsoft. 1 year, they returned 64%. Apple, until recently, the most valuable company in the world, eclipsed by Microsoft recently. You can see a recent downturn in shares of Apple. There are concerns among analysts about iPhone sales, and followed by Amazon, NVIDIA, Broadcom, and Meta. All very familiar names. All have posted big gains over the past year. What about this concern about Apple, for instance? What's your take when there's this concern about a company that can't grow as it has in the past?
I think it's a valid concern, and we actually, after a great deal of discussion, sold our Apple the very first part of this year. It's been building on us. The growth has slowed. That may be a cyclical thing. That's a possibility. Apple is trading at sort of twice the valuations that it was historically trading at. That's fine. Maybe there's very bright things to have. Our consideration and concerns were numerous. First, 24% of its sales, now it's down to 20% of its sales, are in China. And clearly there's a trade war going on between China, or political war going on in China with America. So, the Chinese government is warning its citizens not to bring these products into their own stores. 80%
into government offices.
Government offices, sorry, yes, I apologize. And 80% of its manufacturing capacity is in China. That's not a thing you can easily and quickly solve. So there are significant risks there, and everybody says, well, the Chinese government wouldn't ever do anything to upset the apple cart. I don't think you can count on that. It is a risk. I don't think the Chinese government necessarily cares about a lot of people, and it cares about its own existence. So there's political risks, there's economic risks in there, it's slowing risks, and then secondly, and we're seeing a little bit today with YouTube and Netflix not wanting to adopt the Vision Pro, Apple's Vision Pro.
Right.
One of the problems that Apple's, it's sort of a self-inflicted wound in many respects. One, they've been belligerent to other major companies in terms of protecting their own walled garden.
Right.
And two, because of their privacy considerations, or the sense that only they know what privacy is, they maybe be falling behind in the AI race. And so there are a lot of risks. And there are political risks, but regulatory risks as well, which all these companies suffer from. But given the valuation that it was trading at, and given these risks, we sort of felt that it was more than fairly valued. We don't, you know, we had I think our cost base on it was in the 20s.
Wow.
So, you know, we don't buy and sell things very often. So we take it very seriously because taxes are a for sure loss.
Right.
But we just think, and a lot of people are hanging out in Apple because it's the old, you can't go wrong by owning IBM. And for the last probably my whole career, you've made no money owning IBM. I'm not saying it's going to happen with Apple. I'm not saying bad things, but just it seemed to be fairly priced.